All right, back again to start a fresh chapter and section of the course. We're going to chapter 7 now on fraud, internal control, and cash. So in this chapter, as I say, we're starting a new phase of the course where we'll be reviewing some of the major balance sheet accounts. Chapter 6 kind of got us started in that direction, but inventories are a separate creature that can be accounted for in different ways as we observed. Starting in this chapter, we'll be looking at various accounts more from the standpoint of how they can be analyzed and controlled, although the flavor of this was also introduced in chapter 6. Especially in this chapter, since we're discussing cash, the subject of internal control and how to prevent fraud will be a big part of the discussion. As someone who has worked closely with internal controls for many years, I hope I can contribute something beyond what the text covers. As we go to slide 3 of the presentation showing the study objectives, as you can see, we'll definitely spend some time on internal controls and how they relate to cash control responsibilities. One of the key items is the bank reconciliation, in that this exercise gives us assurance that we, the company, balance with our bank. For a company, it's very similar to how we balance our checkbooks at home, just on a larger scale. Going to slide 4, the usual pictorial type presentation. Because of the corporate scandals of the late 1990s and early 2000s and the resulting Sarbanes-Oxley Act, there's been a lot of focus on internal controls, especially those controls that can prevent or detect fraudulent financial reporting. But since cash is such a liquid asset, there must also be ongoing attention paid to everyday cash receipts and disbursements to ensure they are handled properly to prevent that type of more specific fraud from the standpoint of theft, embezzlement, etc. One potential control over cash is to restrict its use to certain specified activities. For example, a bond repayment fund may be set up whose sole purpose is to repay bonds payable or loans. So when you see the restricted cash bullet there under reporting cash, that's kind of what we're talking about. On slide 5, here we see the fraud triangle that those of you who go on in accounting and or auditing will hear about again in future courses. And this is not just a theory, although it's kind of presented as one, but I've witnessed these factors coming into play for the fraudsters that I've investigated in the past. And there haven't been that many of them, but most of them have followed this pattern. So if someone has the perfect storm of circumstances in their career and personal life, that is, they feel underpaid, underappreciated at work, they may have a gambling or other addiction or behavior that costs them a lot of money, and therefore they can rationalize that stealing from the company is just a sort of payback for what they really deserve. Then it's not too far of a journey from just thinking about it to doing it. So again, the triangle, opportunity, financial pressure, rationalization all play into the potential for someone committing fraud. Excuse me. As we move to slide 6, we've discussed a little bit about the SOX Act before, so here's a refresher on that. The main concern is controls over the financial reporting process. But there are many controls in both financial and operating areas of a company that may have some bearing on overall financial reporting. So the outside auditors are in attesting to the adequacy of the internal control system. That means the whole internal control system, including some of the non-financial aspects that may contribute to financial reporting. On slide 7, this definition of internal control comes right out of the Committee of Sponsoring Organizations, or COSO, otherwise known as the Treadway Commission report that was put out in the early 90s as a controls framework for organizations. You can see that accounting records is only a part of the COSO definition. So this is broader than the SOX Act's concern about controls over financial reporting. when we talk about safeguarding assets. We talk about increased efficiency of operations and compliance with laws and regulations. That obviously will touch on some financial stuff, but also some non-financial things as well. On slide 8, the 5 primary components of internal control, and again, this too comes out of the COSO report and controls framework. The text provides descriptions of these components on pages 337 and 338, so I won't belabor that a lot here. For example, the first, control environment, is perhaps the most important because it addresses the tone at the top. That is, senior management must regard controls as important because what they see as important is what the rest of the company normally will. Monitoring is critical also because controls need to be tested and reviewed periodically to ensure they still operate effectively to mitigate the risk they were designed to mitigate. As systems and processes change, yesterday's control that worked may now be obsolete and a new control may be needed. Happens a lot these days with all the technological change that's going on around us. On slide 9, control activities should be designed to prevent the ability to circumvent the controls to the maximum extent possible. One way to do this is to ensure that each control is the responsibility of only one person. Another is to ensure that related duties that could cause a conflict with one employee, that is the ability to approve an invoice and authorize or make a payment as an example, that those duties are segregated properly to different employees. Finally, documents such as checks and invoices should be pre-numbered and accounted for. For example, in a recent audit I checked on gaps between paid check numbers to ensure that all of the missing checks were avoided for some valid reason, which in fact they were. But the test was needed to ensure that that was the case.
By the Shocker defender leads to the fast break opportunity for Rob.
Sorry, little interruption there. All right, now to slide 10. This chart shows some typical examples of physical controls that may be used in a typical company or organization. So these are things that you would expect to see from a physical standpoint, as far as keeping things locked, restricting access, and so forth. On slide 11, a common example of independent internal verification is the bank reconciliation, which is performed by an employee with no other cash management or custody responsibilities. Another is the reviews performed by the internal audit function, which is a function that that is to be independent and an objective reviewer of any and all company documentation. The key with these verifications is that any discrepancies are reported up the management chain. Now, how far depends on their significance and get resolved. Human resources or HR controls have to do with controlling for variables in employee behavior by bonding employees, for example, that have cash custody responsibilities, rotating employees from duties involving cash and other sensitive transactions, and conducting background checks before hiring to ensure trustworthiness to the extent possible. This example is shown on slide 12, is shown on page 339 of the text. And we see that for the missing control explanation, we see that on that page for the missing control explanation. Obviously, this training supervisor had too much power to both create and approve fictitious claims that were actually paid, since they were approved in the real system and not offline. On slide 13, this example is shown on page 340. This was a segregation of duties issue since this person had the ability to order and receive items and approve payments for them, in addition to doctoring the invoicing process by creating and approving fakes. We're going to see that in smaller companies, it is oftentimes easier to commit fraud because it's hard to segregate the duties when you just don't have as many employees to segregate them amongst. On slide 14, see this example on the bottom of page 340 in the text. An employee, even at a low level one, can have a lot of authority to do things that they should not be able to do by themselves, especially in a smaller organization. This employee had custody over cash, that is blank checks, and the ability to manipulate the accounts through the bank reconciliation process, which is a clear segregation of duties violation. On slide 15, this one is on page 341. In this case, documentation requirements were weak, and that is why the employees got away with their scheme for at least a while. Fraudsters are always caught in the end, but often by accident or by a tip, not necessarily by a formal audit or review. Travel expenses are a prime fraud area for this reason, that is, the lack of enforcement of strict documentation support requirements such as actual receipts versus copies or summary statements. On slide 16, this one is on page 342. Collusion is often part of a fraud since it's easier for two people to circumvent controls than just one. And that's partly because with segregated duties, that can potentially be overcome if two or more people are involved in the scheme. In this case, that is what happened as the two friends collaborated on a scheme to quote-unquote doctor the application documents to show the sales agent's name as if he was involved in the sale of the policy. But loose physical controls were the main culprit in this scheme, as the employee was able to access the mailroom and obtain the hard copies and then alter them. Slide 17 shows a vignette that's shown on page 345 of the text. When you look at this, think about the ramifications of having unsupervised employees or employees who quote-unquote report to each other before looking at the text solution on page 392. On slide 18, limitations of internal control. As any company that went through a SOX Act implementation can attest, and I worked for one of them, the benefits of a control that a control provides must be evaluated against the costs of implementing the control. Of course, benefits can be a lot less tangible than costs and need to be evaluated by senior management using subjective as well as objective criteria. The concept of reasonable assurance comes into play here. I think they talk about that in the text also. No system of controls can provide absolute assurance that neither errors nor fraudulent actions will occur. No absolute assurance. To try to build such a system would be cost prohibitive. That is to basically eliminate 100% of the possibility of errors or fraud. So management must decide which controls have the most bang for the buck in designing the control system. The human element, as noted in the text, includes not only human error, but collusion to commit fraud as well. And with that, we will stop this section of the presentation.